now I want to talk about the competitive landscape. You know, it was largely with you coming in, it became a three-horse race at this point in time, but you've now got the incumbents moving into the quick commerce space. I mean, Big Basket, for instance, now moving full tilt into quick commerce. How is the competitive landscape changing? How do you create moats around you? How different is the Zepto customer, for instance, from a Blinkit customer today?
Yeah. Look, I think at the end of the day, this game is about execution. If we execute well, I think we'll build a very large outcome. If our competitors execute well, I think they'll build a very large outcome. You know, I think competition is probably the difference between, again, just hypothetical numbers, between like, you know, 50 billion and $60 billion outcome, that's competition, that's market share. But from 5 to 50 billion, that's execution. And so, you know, we think we're genuinely lucky to have quality consumer internet players that are our competitors that help us be a better company. We learn from them. Hopefully they learn from us. You know, we think if we just put our heads down, execute well, we'll build a large outcome. So far, that's been true. I mean, I think when we started this company early to mid 2021, I mean, you know, mid 21 to early 2022, that was the most intense competitive period. And candidly, that was when we were the most vulnerable because we had the least amount of capital. We were an upstart. You had all these large established startups that had already gotten into play, right? But our philosophy then, and as our philosophy is now, is listen, just be heads down, execute well. The outcome will be good if you do that. And
do you feel less of an upstart today?
No, I mean, I think it's a good question, but I think right now we're still operating like a 0 to 1 startup. And that, you know, what I tell the Zepto team every day is that we have not made it, right? Like we are not a $5 billion company. We're a $50 billion company in the making if we don't mess it up. That's a simple thought process. You
know, so, and that's what I want to talk to you about. And this takes me back to a conversation that I was having with Sameer Nigam at PhonePe, and he was talking about building and execution and scale, and the silly stuff, in his words, that sometimes we've seen people do. What is the silly stuff that you are mindful of, that you are avoiding or you have managed to avoid? Yeah. And what's the non-negotiables that, you know, has to be done?
100%, and you know, Shereen, I think the silly stuff is essentially allocating capital in low ROI or zero ROI ways, right? Essentially, my job is like an investor, I'm a capital allocator, right? And so my job is to, you know, allocate capital to wherever I see, you know, rigorous paybacks and ROI. And let's say, you know, you launch like 500 markets randomly, right? And like 300 of them are unviable, right? And that's just like capital wasted. There's zero ROI in that capital. Or for example, if you like launch a new business, you know, hastily, you end up sort of blowing up that capital, right? Or if you just go, you know, give 100% of your customer base just like crazy discounts, all that is just like wasted capital because you're not going to get ROI on that over the long term, compounding ROI. I think we've been able to successfully, historically avoid that, which is why if you look at the outputs, you know, with a fraction of the capital that all the other renditions of consumer internet the decade prior, whether it's ride sharing, food delivery, e-commerce, all those other renditions of consumer internet, we've gotten to a scale with a fraction of the capital that they took. And so, in I'd argue, more capital-intensive space. So you can see that rigor in execution there because, you know, we've spent a very small amount of capital to get to the scale that we're at. If I benchmark, let's say, e-commerce, or if I benchmark, let's say, ride-sharing or food delivery, they were multiple times more capital to get to where we are today. So we feel good about that. I think we have to keep holding on to that now that we've got more capital. If you ask me today, you know, do we have a plan to invest all this capital in a high ROI way? The answer is no. And you know, even if I have, you know, XXX cash in bank, I would not deploy a dollar if I didn't, in good faith, believe for our shareholders that it would be high ROI. And today we don't have a billion of investment plan, unfortunately or fortunately.
Yeah. Well, so, you know, take me through from a high ROI perspective, as you just pointed out, the priorities for this year, perhaps over the next 2 years. I mean, what is going to be prioritized? Where will you deploy capital? So how will you deploy capital?
Look, I think it's two major buckets of investments, right? I mean, the way that we look at it is first we have a 10x customer experience across like speed, quality, selection, and price. And we are working on all of them, you know, without going into too many details for obvious reasons, but we've got a lot of work we're pushing on the customer side. That's priority number one of the company. The second priority is how do we build leverage, right? Execution-led leverage, whether that's variable costs improving, whether it's advertising income going down or going up, whether it's, you know, CAC efficiency and excellence on customer acquisition, whether it's new categories that are giving us average order value growth, whether it's the scale and sourcing leverage that we'll be able to unlock on the back end, right? All of that we're working on the leverage side, and there's much more beyond that. And then the third bucket for us is investments, right? And the buckets for investments for us today are, let's say, three broad buckets. One would be, for example, new stores. Very simple. You know, there's a.
So what's going to be the store count at the end of FY25?
So we think we'll be at least 700 stores by March 2025. That's what we put out there. We think we can do a little bit more, but right now, again, we want to be prudent, right? So we're going to go for 700 by March 2025. If you look at, but could be more, but as we speak, that's the plan. And then obviously, we want to invest in new customer acquisition efficiently. And again, we're looking at the paybacks of all the acquisition that we're doing. And then we also want to invest in new capabilities, right? So, for example, new capabilities like building out a full-fledged software stack for advertising, right? That is a meaningful engineering task that a lot of our peers candidly have already done over the past decade, right? And we are building it from scratch today. And we have to put together the team, the resources, we have to give them capital. And so, that, for example, investing in that R&D and that software build-up is meaningful. So those are the 3 buckets of investment. These are the 3 things that we want to do: customer, leverage, and investments.
Let me pick up on the advertising side, because I think when we last spoke, you talked about the fact that the aspiration was to take that number from ad income to about 1,000 crore rupees. On track?
Yes.
Yeah?
Yeah, we're on track. We're, absolute terms, although I think it could be going faster, and the team is watching, so I think it has to be going faster, but I think, less than 12 months, it'll be over 1,000 crores very realistically. Right now, we will start run rating. Already 600, like close to 600-ish. We'll get to 1,000 crores.
So what is the aspiration then? If you said in the next 12 months, or perhaps even earlier, you're going to be able to get to the 1,000 crore mark. What's the aspiration, especially since this is a priority where you are going to be investing your resources in?
Totally. Look, I think the aspiration is, the aspiration is X. Honestly, there's no real number, but I think it obviously is like a percentage of the platform GMV. We think we can scale it to, similar to the best in class, right? The best in class e-commerce players, without naming their names. They in our categories, obviously with a lot of with decades of investment, have been able to get to a very high quality ads product. So we think that there's, let me put it this way, if the platform doubles, I would want ads to at least 2.5x or 3x over the next 2 years consistently. I think we can, we can get it to today 1,000 crores by 2025. If I fast forward to 2027, I think it's very realistic. It'll be a few thousand crores. It'll be hopefully one of the top 10 or if not top 5 performance advertising businesses in the country. Actually, probably top 5 in terms of scale. High ROI, ROAS accretive performance advertising. So we're not a display advertiser. We do display, but our main focus is bidding, search-led advertising, not the banners and the billboards. So that's the way.
You talked about customer acquisition as well. How sticky is the Zepto customer? I'm a one-app person, so but I imagine the ecosystem that you operate in is not like that. How sticky is the Zepto customer, and what do you do to ensure repeat transactions?
No, for sure. Look, I think the retention is fairly high. It's meaningfully higher than, say, food delivery and ride sharing, and the overall baseline over 6-9 months. So I'd say, look, customers are not particularly loyal at scale. And there's no real loyalty. It's about who gives the best customer experience on the field on that day. If you consistently get a bad experience on, let's say, X player, you move to Zepto. The vice versa is also true. If you have consistently bad experience in Zepto, you move to the other player. Which is why we just focus on our customer experience metrics. And historically, we had to take very tough calls. We were sitting in 2020 to 2023, candidly on the verge of death, right? Capital was not capital efficiency was not an intellectual a goal. It was like a life or death constraint. And so we had to really constrain ourselves, and there was lots of things that we had to do just to keep customer experience at a decent place while we could capitalize the company. And we did that, and I think now we are really investing in customer experience. So the store launches that we're doing, you'll see meaningful reductions in delivery times because we're densifying our network. You'll see even as we scale, get more and more sourcing leverage. We think we can get more leverage on pricing, for example, which we believe is a vertical of customer experience. And we're also going deeper and deeper into getting fresher and fresher products for customers. So
you talked about pricing and the leverage on pricing, but how much pricing power do you have today? And do you believe that you're going to be able to continue to enjoy that, given the fact that it's a fairly competitive space and you're going to have more competition coming in? How do you ensure pricing power? Because then that brings up the profitability question and whether this is eventually going to work or not.
Yeah, look, I think it's pretty clear that it's working, right? We were in 2.5 years, essentially a couple of months ago, we went from 0 to well over $1 billion in scale, and we got close to EBITDA break even at a company level. There's no, forget about internet company, there'd be probably zero, large scale, profitable companies, even the settled industries that would have had that scale and profitability curve that quickly. So I think profitability is not really a question. It's more about execution. I think if you look at all our competitors today, the way that we look at it is, all our pricing power, you mentioned, let's say, discounts and like unfair discounts, etc. All of it is coming from structural leverage, right? Like, today if I'm pricing, a product X, firstly, our partners take those calls, based on what they see their margin to be, but, they're not taking calls that are just, hey, let's just like burn money, right? Like everyone today, if you look at, the partners that are running the stores, so 70% of them are profitable, and they're operating at like a decent level of price, then, it's structural in a way, right? Like it's structural efficiency that's driving that. So, we don't believe in like equity capital to fund a customer experience metric, right? Like that's highly unsustainable. And like I think the mistake of the last decade of consumer internet.
That's what I was going to ask you. Would you call that the big mistake of the previous decade?
I absolutely agree. I mean, see, because it's not sustainable, and I'll tell you, to give you a sense, right? It is actually the worst allocation of capital that you can make. If you today start saying, I'm going to put equity capital towards pricing unstructurally, right? And I'm going to, give my partners the ability to do whatever they want, and like we're going to give them like, like no constraints, everybody is crazy, who cares about the P&L? That actually is not going to give you, forget about, you're going to get a pop in GMV, but the second you pull that, it will go back down, and you're not even going to get long-term compounding market share. So if today, like, some competitor comes in and just starts randomly, discounting, which, has happened historically in the past without naming names, then, we think it's like a death knell. Like, that's a
no-go.
That's not, it's a no-go because, like, let's say their objective is, let's take market share from Zepto or XYZ. That's like the worst way to get market share because it's not even long term. Like you're not going to be able to hold on to that market share when you eventually do pull the plug, right? And like capital is a commodity, right? Like we will all be able to raise capital, we will all be well capitalized. It's about execution. So eventually you're going to pull back. If the strategy is, hey, 10x more capital, that never really works, right? And you've seen it with modern trade, you've seen it with aviation, you've seen it with, you've even seen it with telecom. Right? That's historically been a theme.